Assalamualaikum everyone. Good evening. How's everyone? Please open the latest past paper question. Please open the past paper question. Okay, guys, let's start with the requirements. So let me start with the first requirement. Explain the exposure Fondir company faces with respect to the falling sales revenue from Italy and suggest how this exposure could be managed. So we have already discussed this part in yesterday class, but I will discuss it again. So the requirement is explain the exposure company faces with respect to the falling sales revenue from Italy. So that means you are doing some sales to the Italy and that sales is declining, and suggest how this exposure could be managed. And you have to tell that how could you manage that exposure. B part, prepare a report for the board of directors of Fondir company, which calculates the amount receivable in dollar from Lothal in 4 months time using the over-the-counter forward and OTC option. Believe me, this both part were present in Lignum company. The question which I have suggested for the homework, for the home assignment. Okay, the next is calculate the interest return. So it's a case of lender interest return, not the interest cost, interest return in dollar of the cash flows from Lothal when future contracts are used to hedge the interest rate fluctuation of 0.5%. Calculation. Guys, give me 1 minute. I'm taking a pause for 1 minute. Okay, the second part is calculate the interest return in dollar of the cash flows from Lothal when future contracts are used to hedge the interest rate fluctuation of 0.5%. Calculation should include the number of future contracts needed and the gain or loss in the future market in dollar. Guys, normally we used to calculate the gain in percentage, but here examiner has specifically asked us to calculate gain loss in dollars. Comment on the result obtained in part B1 and B2 and addresses the queries raised by the board with respect to the alternative methods to hedge the receipt and the margin requirement. In the last part, discusses if it would be beneficial for the Fondir company to manage its financial risk and whether or not the company should communicate its risk management approach to the shareholder. Okay, professional marks will be awarded for the demonstration of skill in communication, analysis, evaluation, skepticism, and commercial acumen. Let me tell you the last requirement again. Discuss if it would be beneficial for the Fondir company to manage its financial risk and whether or not the company should communicate its risk management approach to stakeholders. Guys, this part has been tested like 2 to 3 times in the past papers as well. So remember, I have recommended one technical article for the study, that is why risk management. So there is a video available on the LMS that's name is why risk management. Why risk management is important and why should you communicate it to the stakeholders. Even it has been tested in the past papers as well. So that's 9 marks. Okay, let's read the text of the question. Fondir company based in US, currency is the dollar, is involved in the production and sale of high quality foods under its popular brand called Daily Belly. Initially, its products were mainly aimed at the USA market, but increasingly, the products are sold internationally to North and South America and to the Europe. This rapid growth has meant that Fondir company is expanding its production facility and receiving its revenue in a variety of currencies. Fondir company has developed robust system to manage its operational risk, but so far it has not managed its financial risk from currency and interest rate fluctuation. Fondir company board of directors on the whole is supportive of the opinion that company financial risk should be managed using derivative products, and the company approach to risk management should be communicated to its main stakeholder group, including shareholder, manager, lender, and employees. Fondir company marketing director question whether these and other financial risk should be managed at all. So marketing director is asking whether we should manage that or not. He suggested that cost of managing such risk would be outweigh the benefits derived from the management of these risks, and therefore would be disadvantages for the company. The finance director argued that although many risks can be managed using derivatives, some risks were harder to manage. She gave the Italian market as an example, where direct competitor from France and Germany have successfully penetrated the Italian market. As a result, Fondir company has found that its sales revenue from the Italian market has been falling, and the FD suggests that this is due to weakening of the euro against the dollar. Okay, the FD is of the opinion that this relative weakening of the euro is likely to continue for the same time and cannot be managed through the use of derivative instruments. So this is a longer time risk. And if the transaction risk is a longer time risk, that result in the economic risk. So this is actually the economic risk. Okay, the next is Fondir company sells its product to companies and customer based in Lothal, a country based in Europe where currency is the lira, Lothal lira. It is expecting a receipt of 357 million lira in 4 months time on 1st May. Okay, after 4 months, if it's 1st May, today is 1st January, right? Although there are no exchange traded derivative products available for hedging in lira, Fondir company has access to over-the-counter OTC derivative products. The first is 4-month forward rate agreed today based on the Lothal annual base rate of 6% plus 60 basis point, and the USA annual base rate of 3.3% less 30 basis point. Spot rate is 84 LL over dollar. So you need to calculate forward rate using interest rate parity. So you will use the interest rate parity and calculate this rate. The second is an OTC call or put option with an exercise price of 84 LL. Premium for the call option is LL4 per dollar, and for the put option it is this. Option premium is payable at the commencement of the option contract, and the Fondir company would borrow the money needed for the premium using its overdraft facility. The company pays interest on its overdraft at annual rate of 5.4%. BOD wants to know how the currency exposure of this receipt can be managed. Use the two instruments above, and also whether it is possible to hedge this using alternative method and not the derivative instrument. So that was question about the currency. And the last one is from the interest rate risk management. Fondir company will choose the more financially beneficial hedging instrument to hedge the cash receipt from Lothal. Once the cash has been received in 4 months time and exchange into dollars, so you will convert into dollars, it will be invested for the further 5 months. So you will invest in further 5 months. So you will invest after 4 months for a period of 5 months. Okay, Fondir company board wants to know how interest rate future can be used to hedge against the increase or decrease in the base rate. Fondir company invest funds on a short-term basis at the USA base rate, that is 3.3% less 30 basis point. Following information is provided for the future. Contract size is 500,000. Contract price is 96.10. In the calculation, the following can be assumed. Settlement of the future contract is at the end of the month. Basis diminishes to 0 at a constant maturity. Based on a monthly interval, there is no basis risk. Margin requirement can be ignored. Board has heard that dealing with future can be expensive because of the margin requirement. Dealing with the future is expensive? No. Margin is very little compared to the whole transaction. They want to know what margins are and whether or not dealing with future is expensive because of this. So we need to discuss this, obviously. So let's discuss all the parts one by one. So let's discuss the very first part. The very first part is, okay, explain the exposure of Fondir company faces with respect to the falling sales revenue from Italy and suggest how this exposure can be managed. First of all, you will explain the scenario. You will explain the finance director has taken the example that the currency of the Italy is weakening against the dollar. So because of the weakening of the currency, it will be cheaper for the Italian customers to buy the products of the European exporter. And your products will become expensive there. And if your products become expensive there, so your sales value will decline. And it is clearly written, according to the finance director, that this is a permanent shift in the exchange rate. Exchange rate has depreciated. Euro has depreciated compared to the dollar. So there is no chance that in future currency will reverse and your sales will start increasing. There is no chance of here. Okay. Then you will write if there is a short-term exchange rate, short-term fluctuation of the exchange rate that can be managed through the transaction. If there is a short-term exchange rate, that is transaction risk, and that can be managed using derivative, using forward, future, options. But here there is a permanent shift. So it's a long-term risk. Although there is one derivative that can cover the long-term risk, that is currency swaps. But here in this case, currency swap will not work. So it's a permanent shift. It's a long-term risk. So what could be the possible solution? You can suggest that Fondir company can open its subsidiary in Lothal in Europe. So if you open your subsidiary in Europe, your exposure will shift in euros and you will start making products at a cheaper price and you can sell at the market competitive rates to the Lothal company. To Italian company, sorry, to Italian company. You can make the products there and you can start selling products to the Italian company. Second solution, make some innovative products, make some create some brand loyalty set in such a way that Italian customers only buys goods from your company. Rather than buying from other European countries, they prefer to buy from you. Create such a brand loyalty of your products. And another solution which you can suggest is diversify into other markets so that your risk of relying on the Italian market may reduce. So that's the solution which you can write. First of all, explain the scenario and identify which kind of risk is this. Then you can compare it with the short-term risk, that if there is a short-term risk, that is transaction risk, that can be covered using derivative, but it's a long-term risk. It cannot be covered using derivative, although there is a long-term derivative that's name is currency swap. But this kind of risk cannot be covered using that. And if there is a permanent shift in the exchange rate, how to manage that? You can open subsidiary here. You can put some investment and open your factory there. Diversify your products into different areas. Diversify into different new products. Make a new innovative products, or create a brand loyalty. It's a food business, so you cannot make an innovative product, but you can create the brand loyalty. Okay, that's for the A part. So let's discuss the B part. Calculate the amount receivable in dollar from Lothal in 4 months time using over-the-counter forward. So let me open the spreadsheet. Let me open this. Appendix 1, part B1. So first of all, over the counter forward contract. Okay, now first of all, we will calculate the forward rate using interest rate parity. Spot rate is Lothal lira over dollar. That is 84. Lothal interest rate is 6% plus 60 basis point. Dollar interest rate 3.3% minus 0.3. Now calculate the forward rate. And forward rate must be how many months? It must be for 4 months, right? For 4 months. Four-month forward rate. Spot into 1 plus LL interest rate into 4 by 12. Divide by 1 plus 0.03 into 4 by 12. So 84.99. Now foreign currency amount is 357. Expected home currency amount divided by this 4.2 million. That is $4.2 million forward. Okay. Now options, OTC option. First step, foreign currency amount. Second, currency's option is in dollar. It's a dollar option. So we are receiving LL. So we will be selling the LL. We will be buying the dollars. Guys, OTC option is price in dollars. OTC dollar call or put option, right? OTC option is in dollars. So as the export, as the receipt is in lira, so we will sell the lira and buy the dollars. So it's a dollar call option. Exercise price is 84. Okay. Now there will be no number of contracts. And let's calculate the premium cost. Okay, premium is in 4 LL per dollar. So it's a 357 million LL into 4 over 357 million. That is 4 LL over dollar. 4 LL over dollar. So that means we have to convert it into dollars. So expected receipt FX size. So if we exercise, what is the expected receipt? 357 divided by 84, 4.25 million. So $4.25 million into 4. So this is the premium cost. This is dollars. So this is the premium cost. This is in dollars. This is in LL. And convert the premium in dollars in home currency. What is the today's spot rate? That is also 84 over 84. So this is the premium cost. Guys, this is the premium cost. Okay, now what is the total cost? Total receipt, sorry. Expected receipt is given. Premium in dollars is given. You can also add the interest of the into the dollar cost. %5.4% is the interest. Interest on premium into 5.4% into 4 by 12. So this is your income. This is your cost. This is also your cost. So 4.04 is your net receipt. So let me revise that what are the steps which I have taken. First step is identify foreign currency amount. Second, identify call or put option. So why I have chosen it as a call option? If you look at, it is given dollar call or put option. Dollar call or put option. So you have to think in dollars. As you are receiving the lira, so you will sell the lira, you will buy the dollars. That's why it's a call option. It's a call option. Okay, then you will write the exercise price and then you will calculate the premium. And there is no need to calculate the number of contracts. And there is only one exercise price. So if excise, what is the expected receipt? 357 million divided by 84. This is the excise price. This is the excise price. Then what is the premium cost? Premium is 4 LL per dollar. So you will multiply 4 into 4.25 the expected receipt. 17 million LL is the premium, but we need to convert into the today into the dollars using the today's spot. Today's spot rate is also at 84. So this is the premium cost in dollars, and this is the interest on premium. You can ignore it because it's immaterial. But if you want to write, that is the interest amount. Okay, that's how you will calculate the OTC option. Okay, next part is part B, second part. Guys, if you want to revise even the OTC option, I have uploaded the video on the YouTube as well. It's a video available on the YouTube as well. Okay, now short-term investment. Short-term investment. Okay. Let's solve the next part. This is the over-the-counter, sorry, this is the interest rate future. Interest rate future. First step, if you remember, amount of borrowing or lending. So amount of lending here. No amount of lending is given in the question because the examiner wants you to identify from the above part. So which receipt you will take? Option receipt or the forward receipt? Which receipt you will take? Option or forward? In option, we are receiving 4.04. In forward, we are receiving 4.2 million. Okay. Let's assume that company will select the higher receipt case for investment purpose. Okay. That is dollars. 4.2 million. You can write it 4.2 million. $4.2 million. So if you remember, it's a case of lending, receive interest. So we will buy future. Buy future. And we are receiving in May, so June future. 96.10. That is 3.9. 3.9%. Number of contracts. amount divided by contract size, that is 500,000, into duration of loan. You are investing for duration of investment. You are investing for 5 months. 14 are the number of contracts. 14 are the number of contracts. Okay. Now there are two cases if interest rate increases or decreases. So calculating, close the position. Buy future. If rate increases, if rate decreases by 0.5%. By the way, what is the current rate? Current rate is 3.3%. If rate increases by 0.5%, so it will move to 3.8%, right? If interest rate decreases by 0.5%, it will move to 2.8%. So let's calculate the closing future. Guys, what is the formula of closing future? Closing spot, that is 3.8%, plus opening future, 3.9%, minus current spot, that is 3.3%, into remaining months divided by the total. So we are standing at 1st January, we are selecting the June contract and we are executing the contract on 1st May. So that is into 2 divided by 6. So 4%. 4%. You can also write 4% means 96. And here you will (3.9%). Sorry, closing interest rate. This 2.8 into 6.12, 3.17. Am I right? 3.9 plus, sorry, 2.8. It's not. Opening future. Minus current spot. That is 3.3%. 3%. 3% means 97. Okay. Today is 1st January. We are selecting the June contract, so total are 6 months. But in question, it is written that we will invest on 1st May. So that means we will invest 2 months earlier. So remaining months are 2 divided by total months are 6. Okay. You have agreed into the contract that you will receive 3.9. But market moves to 4%. So that means here you will face a loss. And here you enter that you will receive 3.9, but in market moves to 3%. Here you are getting a gain. gain. So there are different ways to solve it. Into number of contracts, 14, into contract size, 500,000, into 3 by 12. One 750. Gain into number of contracts into 500,000 into 3 by 12. Okay, now expected income, actual return in market. So in market, interest rates are 3.8%. And the loss is this. So the net income is 3.7%. In market, actual income is 2.8. Gain is this. So the total income will be this. So if you want to calculate the total income, that is 3.7 into 4.2 million into how many months are there? 5 over 12. 5 over 12. Okay, no. Here, if when you invest, you will invest at 30 basis point lower than the rate, right? Minus 0.3%. Minus 0.3%. So total exposure will remain same. Total return. So that's how you will calculate the total return. %3.4%. Okay. I think numerically it is much easier question. Interest rate parity calculation. It was very easy. Look, spot rate is given. Spot rate is lira over dollar. Lira interest rate, identify the lira interest rate. That is 6% plus 0.6%. 6% plus 0.6%. Then identify the dollar interest rate. That is 3.3 minus 3.3%. Then take the spot rate into 1 plus R into 3 by into 4 by 12 divide by 1 plus R into 4 by 12. So I have calculated using this. Any question, guys? 4 quarters in a year. No, it's not the quarter. Actually, we are investing after 4 months. We are receiving funds after 4 months. That's why we are doing 4 by 12. It is written in the question that you will receive money after 4 months. That's why. Yes, same apply for the 4 months. That's why 4 by 12. Same rule apply for the purchasing power parity. But purchasing power parity only calculates the future spot rate. Why we are taking calculating loss and gain 3 by 12 in it's the part of the formula. Here okay, I think you are asking from this perspective. This is the part of formula. Gain loss into number of contracts into contract size into 3 by 12. You can use a other formula. Calculate number of ticks into tick value into number of contracts. You can use that formula. It's up to you. Which formula do you want to use? So let me solve in the use the tick way. Divide this with 0.01%. So number of ticks are 10 into tick value. For 500, I think tick value will be 12.5 into number of contracts 14. You can solve using this way. It's up to you. Which formula do you want to use? Okay. Okay. Now we have to make a report. In report, I think its report is also very easy. In report, what we have to write, comment on the result obtained in part 1 and part 2 and addresses the queries raised by the board with respect to alternative methods to hedge the receipt and the margin requirement. You have to tell what are the other methods, you have to tell what are the margin requirements, and discusses if it would be beneficial for the founder company to manage its financial risk, whether or not the company should communicate the risk approach to the stakeholders. So how to make the report? Part B. Report to the board of directors founder company. Simply, you can write this. Okay, now instead of writing the subject, you can directly write the introduction. This report covers that how founder company can hedge its foreign currency receipts and legal. Derivatives for foreign currency receipts and interest rate future for investment. That's the you will put the introduction. Also covers discussion of the result of these derivatives and also covers other methods, margin requirement, and importance of risk management and communication. So that should be the introduction. Now the first heading should be discussion on result of foreign currency receipt hedging. Okay, you will discuss this. Obviously, you will write that forward is the best one. Then you will discuss discussion on the result of dollar investment hedging. Then next heading should be the other methods. Other methods and margin requirement. And the next heading should be importance of risk management. What was the requirement, by the way? Importance of the risk management and communication. Okay, then at the end, you will write the conclusion. Okay, that's how you will write your report. And when you are referring to the result, you will refer as writing by appendix number 1 or appendix number 2. So you will write in this heading that result obtained from the over-the-counter forward is giving 4.2 million and compared to the option contract, which gives you 4.04 million. Okay, why option contract is lower? Because in option contract, we have to pay the premium that is also in advance. But the benefit of option contract is if market moves in adverse direction, option will protect you. But if market moves in favorable direction, you can lapse the option and you can enjoy the market favorable rate, but that flexibility is only available in option contract. And here you will discuss that when the company receives the money after 4 months, company will ensure that you can able to invest that at a fixed rate. And here, using the interested future, you can lock your position at 3.4%. That is 59,000. 59,000 is the amount. So whether interest rate rises or whether interest rate falls, you have locked your position. You will receive your income at 3.4%. Okay, but you will write that hedging based on interest rate future has some drawbacks. Number one drawback is you're assuming that basis risk is zero. Slightly discuss that there is a basis risk. There's a difference between current rate and the future rate, and it is assumed that basis risk will diminish basis point will diminish to the zero and there is no basis risk. But in reality, there can be a basis risk. Okay, then you will discuss what are the other methods, and you will discuss company can use the alternative methods to hedge this. What are the alternative methods? The number one alternative method of hedging the currency is you can use the money market. Explain briefly the money market, that you can borrow, you can lend the funds in lira in the present value, and you can borrow the funds in dollars. So you can explain that. Sorry, borrow the funds in lira and invest in dollars. Briefly explain that. You can also say that instead of using the OTC forward and option, company can also hedge using the exchange traded derivatives if available, but it is clearly written that that is not available. So one over the counter derivative can also be available, that is swaps. You can use one-off swap, currency swap for this transaction. Otherwise, the best method which you can recommend is money market hedge. Okay. Then you will briefly explain the margin requirement. Then you will discuss about the importance of the risk management. And obviously, what are the benefits of risk management? Number one benefit of risk management is your financial risk will in control. If you hedge your borrowing risk, your interest rate risk, your financial risk will reduce. And if your financial risk reduce, your cost of equity and cost of debt both will reduce, your WACC will reduce. And if you able to hedge all the currency risk, your operational risk will reduce. And if your operational risk is reducing, your cost of equity will be in control. Your cost of equity will reduce. That's the benefit you can write there. Okay. And you can also write that if company is doing the risk management, that is also beneficial for those shareholders who are not well diversified. If the shareholders are well diversified, okay, that means your hedging will not give them additional benefit. But if shareholders are not well diversified and you are doing the hedging, that will give the benefit, that will give edge to the shareholders. Then you will write that there is always a benefit of communication. If you're doing the hedging, communicate it to the shareholder. Because if you are doing the hedging, it is a message, it is a clear-cut message for the shareholder that company is caring for the risk. Company is doing hedging for the risk. So shareholder will remain calm. Shareholder will remain satisfied. They will not let me tell you with the help of an example. Like the countries like Pakistan, Sri Lanka, Egypt, all are suffering from exchange rate fluctuation. Even Turkey, all are suffering from exchange rate fluctuation. So I'm the shareholder of one of the company, and if I know that these countries are going through massive, some brutal kind of exchange rate fluctuation, if I'm the shareholder of any company which is operating in these countries, I will be worried, obviously. But if there is a proper communication that company is doing the hedging, I will remain calm. I will remain satisfied because I know that company is doing the hedging. That's the benefit of communication. Shareholder will not sell the shares in panic. Even debt holder will not demand immediate return of the money because debt holders know that company is managing the funds. Even the employees or the senior management will remain loyal with the company because they know that company is doing the hedging, company will not be in problem. Even the supplier and customer will have a more trust on you because they know that company is doing the hedging, company is managing the risk. So they will remain attached with you, they will remain in control. So that's the benefit of the communication, guys. And then obviously at the end, you will write the conclusion, that's how you will write the report. Okay. Any question, guys? After the conclusion, also write the report compiled by and date. Now, your assignment should be resolve the question and try to write the report of on this question. That should be your assignment. So how was the session, guys? Thank you so much. I will try to upload few videos on the YouTube as well. So do subscribe that channel and do recommend that channel to others, and also do recommend us to others so that other students can also get the benefit.